Hey, everybody. Welcome to the Cup of Joe podcast. This is episode 1. Really excited to be here. So I have a really special guest here today. And some of you may, here's what I would say. Close your eyes and listen to him talk. Because you've heard him over the phone for my clients. This is Kevin Napoleon, lender with Key Mortgage. Welcome to the show, Kevin.
That's a creepy introduction.
It was. It was a little weird, but I thought it was funny. But yeah,
having me on your first ever podcast, I believe, right?
Yeah, first.
It's like well-oiled machine, as you could tell.
Yeah. We're not going to edit any of this.
All right, so you want to talk mortgage business, huh?
Well, before we get into that, why don't you tell us a little bit about yourself, like how you got into the industry, how long you've been in, things like that, because I know you have been through a lot of ups and downs in the industry.
Yeah.
The collapse before that, the early 2000s, and the recovery after that, COVID, right?
Yeah, and you may not even know the full background. So I have been in this industry since 2001. Essentially the only business I've been in. Went to Illinois State, got a degree in criminal justice.
Oh, I did not know that.
I was going to go down the path of law enforcement. And when I was ending my degree, I had to do an internship, and I did the Secret Service, which was awesome.
Really?
Yeah.
Wow.
And I said, I want to become a special agent. It's a cool job. I would really enjoy it. I was embedded with the Chicago Special Service, Secret Service agents. And when I graduated, they stopped hiring right out of college. So I had to get a job for 3 years before I can transition and apply for a special agent. Becoming a police officer takes a long time. So as I was going through all the testing, I ended up getting what I called like a regular office job for a company called Washington Mutual. And I started in 2001 in their corporate relocation division for mortgage lending.
Wow.
So as I was starting out, right out of college, I was making pretty good money. And I thought, you know what? I'm going to do this instead of law enforcement. So I canceled the search and whatnot. And I stayed in it ever since, which is good and bad.
Yeah.
Like you just highlighted, everything was awesome until 2008 hit. And that was an awful time in our economy, awful time in the market.
Yeah, for everybody.
Certainly learned a lot. That's the whole, the crazy risky loan programs, the deceptive mortgage lending practices. So I lived through that. Fortunately, the company I worked for, or at least the division I was in, was never really part of that. We were all just, whatever the normal guidelines would be, we would have to follow that. And I have been with a few other large national banks, so I kind of know what that side of the industry is. And now I work for Key Mortgage, which is a privately owned small company, which is a whole different other side of the world, which is just nice and easy. I think we were talking about that before, where each company has pros and cons, but it's nice when you just work with regular industry guidelines as opposed to industry plus corporate guidelines. So it actually makes it easier to talk to consumers and sort of help guide and educate people and what they need to know. Yeah,
you don't have to go through all the red tape and
yeah. Especially during like COVID, it was a lot easier just because there was no bureaucracy, however you say that word, and it was just easier. I don't have. Kind of like the movie Office Space. It's Office Space, where you had 7 different managers.
Oh, yeah.
You don't have that, but...
Yeah, you don't have to go talk to your manager to get something, and then they have to talk to their manager's manager.
Right.
The slows everything down.
So-called red tape. So, but yeah, that's in a nutshell my background of how I got in the industry. So I've been in the industry ever since. I've never done anything else. And it's the only career I've had, only thing I know.
That's really cool. I remember the early 2000s. It's when I wanted to purchase my first place. And it was a little condo in Four Lakes, actually.
Yeah.
Right? I think we may have talked about this before. And
you said early 2000s?
Yeah, like call it 2003 or 4. And I think like a little 1-bedroom condo there was 180, 190 grand. And you go and get pre-approved, the 23-year-old getting approved for whatever. I mean, it's different for everybody. I mean, I wasn't making a ton of money at that point, and just being approved for 650 or something like that. I remember it being like absolutely ridiculous, and it didn't make sense. I just pure luck, I think, or whatever the gut feeling was for me was just like, I'm not going to do it. It doesn't make a whole lot of sense. And then, a couple of years later, I think they were selling for, 60, 50 grand. Yeah. I mean, it was a legit difference. And I just got lucky from that standpoint.
Yeah. I had a friend that bought in that area, and that happened to him. And that happened to everyone that bought at that time. I was part of that. And I live in Plainfield now. I bought in 2005. My house probably lost 50% of the value, but I didn't move. So it really didn't affect me at all. But the people that were moving or could not afford their house, then that was a whole different thing. Plus, you just mentioned you were 23. So that is something that is almost non-existent now, talking to 23-year-old buyers. We were just at a meeting talking about a report, I think, that came out from NAR.
Yeah. The average age.
Yeah. Did you see that?
I did.
There
Crazy.
were 3 ages in there. The average age was 40.
40 for a first-time home buyer. The average age of a first-time home buyer right now is 40 years old.
The average age of any buyer, I think it was 53.
Okay.
And the average age of a seller, I think, was 63.
Yeah, that's crazy.
Made me feel young.
Yeah, I know. I'm a young buck.
40.
Yeah, I'd just be buying. Well, no. Yeah, 40. That's I mean, it's a big.
I think I was 20. I was almost the same age, maybe 23 or 24.
Okay.
When I bought my first place.
Okay. Yeah, I was 32. Yeah, 32. So crazy.
Not anymore.
Yeah.
It's hard to believe.
It's interesting too, that like the average seller age, a lot of my clients last year that were selling were a lot of people that were downsizing and were moving from, whatever, a 4-bedroom, 2.5 traditional single family home to a retirement community, or just downsizing in general. But they were waiting, right? I mean, so that they, for rates to come down, which we're going to talk about some of that stuff today, which, and probably smart, right? I mean, right? It just makes sense for them to do that, right? So, but last year it started to happen. I felt like last year was going to be, what do they call it? A silver tsunami with all of that stuff.
Yeah.
And I think it just kind of trickled in last year, but I do think that that's going to happen more this year, where there's going to be a lot of folks downsizing and getting into smaller homes, because I don't know, at some age you don't want a huge home, right?
No, I hope they downsize and sell their house. Mm-hmm. I hope they don't fall into this pattern that a lot of people have sort of started doing, where they would end up downsizing but rent out their house.
Yeah.
Because they're locked into these crazy historic interest rates that they don't want to sell the house. They want to keep it, which, is great for them, but for the housing market in a larger scale doesn't benefit all these up and coming buyers that want to buy something, because there's still very little homes to buy.
Yeah, that's right. And most of the folks that I've worked with last year selling that were in that situation, I mean, most of their home for the most part was either paid off or very close to being paid off too, right? So but it's just different for them, because it's either they're going to be on a fixed income or because of retirement, or they just they don't want that extra expense. And there was a lot of fear, I feel like, from that standpoint, last year or two. So, but I feel like that's definitely subsided from.
I feel like it's more positive. There's more buyers out there, more interest. which I know has always been there for the last few years, but it just, hopefully there are people that hear about the rates coming down, which is what we'll eventually talk about, that it wants to kind of force them to sell their house and be comfortable with it.
Be comfortable, right?
Know that they can finally move on and upgrade to a house that they want, that they can fit in, that they can have a bigger yard, whatever the case is.
Yeah, whatever they want, yeah.
And my big thing, honestly, I would like the real estate market to go back to the way it was maybe 20 years ago, where a buyer can make a contingent offer on their house selling.
Yeah, that's fascinating. Because it's almost not, or the past few years, it has been not, I wouldn't even say borderline, just unfair for folks that had to sell their house first. I have seen that start to happen. More contingent offers. Actually, a friend of ours that we're working with made a contingent offer and got it accepted. So, and that's just a one-off. That's starting to come back. Things are balancing out, which is good. It's good for the consumer. It's really good. Might sound crazy, good for the seller as well. From a point, you don't have 100 people going through your house on a Saturday afternoon. That was really a thing, right? And that certainly stopped. But from a buying standpoint, it is all starting to even out, which is good.
Yeah.
Cool.
Are we going to talk about the Bears-Packers game at all?
Do you want to talk about the Bears-Packers game?
That's why I was here.
I don't want to talk about the Bears. I'm a Packers fan, for those of you that do not know that. I think most of you do. But thanks for bringing that up. And thanks for swinging by. See you later, Kevin.
And scene.
That was tough. Did you watch it at home or?
Yeah. The older I get, the more I don't want anyone around me watching a Bears game, especially a meaningful game.
Especially a Packers fan.
Yeah. I have a TV in my basement, and I sit down there with whatever snacks, whatever drinks I'm going to have, and I don't want to hear from anybody.
Yeah.
I don't want any goofy comments. I don't want to hear about the refs. I just want to watch the game.
Talking to you, Gino.
Yeah.
We've been going back and forth. Gino's my cousin. He's a Bears fan.
Yeah. So I just sit there, usually pouting the whole time. And
sounds about right.
In these last couple Bears games, I was pouting for about 56 minutes of the game until the last 4 minutes of each game, which is fantastic. So
yeah,
going to enjoy this one.
Yeah, I'll let you. I was a little upset. Same thing. I didn't want to have anybody over. I was telling my friends they wanted to come over and watch the game, and I was just like, no, I don't want my true colors to show in front of everybody. Yeah, because it was an intense game.
Yeah,
and I knew it was going to. But we had fun. My wife and the kids. We were just watching it over here, and
yeah, I wouldn't even let my kids or wife be around me.
Well, Yota's a pretty hardcore Bears fan, which I'm surprised I have not changed the locks yet.
That'd be even harder, right?
Yeah. No, she's been good about it. I'm happy for her.
Maybe that's why you're living in your basement now.
That's right. I'm stuck down here. My neighbor took my Packers flag off the front of my house at, I don't know, whatever, 1 or 2 in the morning, and replaced it with a Bears flag. Yota, my wife, heard something going on in the front of the house. And I don't know if you remember, it was really windy that day. And she's like, hey, I think something's going on in the front of the house. I'm like, it's windy. Don't worry about it. And checked the Ring camera. And there's my neighbor, Ed, switching out the flag.
As he should. Yeah. Thanks, Ed.
Yeah. Thanks, Ed.
All right. Now that we got the Bears talk out of the way.
Yeah.
I needed that.
Didn't really want to talk about that. Again, let's talk about some mortgage myths. Maybe this is probably more geared towards first-time home buyers, right? Mm-hmm. Of what you need, what you don't need, what's important to have ready to go, and why you should have a pre-approval. I feel like it's all out there of why you should need a pre-approval. It's always good to just kind of rehash it so it's out there more. But I think the first thing is needing 20% down to buy a home. I mean, that's a myth. I mean, I think for the most part we know that. And you do not need 20% down. Does it help? Yeah, of course it does. And it helps from a rate standpoint, right?
So maybe not. So that is certainly still not only a myth, but it's something that you think with the internet that people can kind of dig through these details on their own while they're kind of doing some research on buying a property.
Yeah.
But a lot of consumers, when I first talk to them, either they're sort of embarrassed to talk to me to get a pre-approval because they don't have 20% down. And they will start out by saying, you know what, I don't know if I can buy now because I know I don't have 20% down, so maybe I'll wait a few years. Mm-hmm. So people still have this thought that you need 20% for a down payment, which you almost never had to have 20%. I don't know where that thought came from. There's a target threshold for 20% because of some of the dynamics of how the loan is structured with PMI.
Yeah.
So there's a certain insurance that, for you folks that have owned a house before, if you put 20% down, you have no PMI, which is called private mortgage insurance.
Which is an additional expense on your monthly mortgage.
Yeah, I might as well talk about that because that's something I want to talk about, like people trying to do 20%, even from a strategic standpoint. So the PMI is there. There's a risk-based calculation with it. And a long time ago, someone must have come up with some analytics that if you do less than 20% down, you're more likely to default on your loan. So they would add an insurance policy to the payment in case you go into default that protects the lender to a certain degree. So a lot of people would want to do 20% down so they wouldn't have to pay PMI. Now, the thing is, PMI over the last, 10 years or so, probably ever since 2008, has gotten way less expensive. If you have good credit and you have 10 or 15% down, sometimes that PMI is $30 a month. So
that's nothing.
If you have bad credit, that could be $200 or $300 or $400 a month. So there is definitely a difference behind the credit, but good credit lessens risk and more money down lessens risk. So there are a lot of first-time home buyers that, their parents would tell them, save up, you have to do 20%. You don't want to pay PMI. It's a waste of money. But then when we start talking through the details and we show them, hey, 15% down is still a lot of money down, but not a full 20. So you have a little bit of savings post-closing, only affects your payment by $30 or $35 a month.
Yeah.
And it's not a forever thing. It drops off when you get to that 20% threshold. So a lot of people end up going less if they have good credit, and it's just a small amount of PMI.
And that extra cash for a first-time home buyer.
Oh, yeah.
I mean, what if something goes wrong, right? Like, I mean, when you're a homeowner, you're like,
yeah,
at that.
Well, I can tell you, my heat went out last February.
Okay.
And it was old. It was like an original unit with my house, so I knew it was going to happen. Yeah. I had to do a new furnace, and since my air conditioning was just as old, I said, let's do the new air conditioning as well, so I'm done with it. It was $14,000.
Yeah.
I did a humidifier, so maybe that's a little bit extra, $1,200 or so on there. And I didn't get any fancy bells or whistles with it, really. Yeah. It was just kind of whatever I have now, replace it. $14,000.
That's a chunk for anybody. Really.
I was dry heaving.
Yeah, well, I
knew it would be a lot of money.
Dry heaving for you.
I really don't want to talk about that. Let's go back to the Bears.
I don't know. I'm going to keep bringing up your AC.
But yeah, you have to have, even when things weren't crazy expensive like they are now, you still want to buy furniture. You want to buy TV. Yeah. You might want to buy a couple microphones and do a podcast in your basement. All this stuff costs money, and it costs a ton of money.
Yep.
And you also just want to be comfortable where you're not, worried about if something does go wrong, you have no way to pay for it.
Right.
So I am always on the side of potentially putting less money down and having some cash on hand.
Yep.
If the payment still lines up with what you want.
Yeah.
So, but yeah, a lot of people think 20% down. And like I said, I mean, if you're buying investment property, that's different. If you're buying a rental property, then you need 20% down. But owner-occupied property, I don't know of any circumstance where you've ever required that outside of a one-off situation, terrible credit or usually just rental properties.
Yeah, rental properties, and we don't...
Or multi-unit, if you're buying a 4-unit building, there's those guidelines have changed a little bit, but, traditional single family home, owner occupied, condo, townhouse, you can do, usually 3 or 5% down.
Yeah. And it makes sense.
Yeah. If you're VA, then no money down. If you're a veteran, a qualified veteran.
Yeah. What I have learned in my career, how beneficial it is for your agent to be connected to a lender as opposed to your client just going on Google and trying to get a pre-approval. Why don't we just go down that path and in different things? But my experience that I've had with clients going onto Google, getting a just like a blanket pre-approval, it usually is just at the end of the day it didn't hold. You would get through a certain portion of the transaction, and then at the end it falls apart because whatever that online pre-approval, wherever they got that from, I don't want to put names out there, right?
Yeah.
Didn't do it the correct way. So, what do you want to add to that? And then the deal falls apart. It doesn't close, and there's a whole lot of
that's the biggest kind of gripe that a lot of people have is when they talk to their real estate agent, and their real estate agent tries to get the buyer to talk to their mortgage person. They're wondering why.
Yeah.
Why does my real estate agent care who I'm getting a loan for?
Yeah. Does my agent? Yeah.
I gave him a pre-approval letter. What does it matter?
Yeah. Like, does he get a kickback? Like, I don't get kickbacks.
Yeah. A lot of people think there's some sort of under the table, which is illegal.
It's against the law. Yeah. We cannot do it.
That person that's helping you, they don't really have any risk to their career if that transaction falls through, if they said something that was incorrect, if they weren't researching guidelines, because they have 100 new people coming in the next day looking for that same service. Whereas someone in my position that is licensed by the state of Illinois, all my transactions are referral based. So there's a huge reputational risk if I start to falter on whether or not someone's approved, or if I'm not giving them the right customer service. I have to make sure this is going to go all the way through to closing. Otherwise, my name stops getting handed out to buyers. So I have to take that pretty seriously.
Yeah. And to that point, not to cut you off, we're connected as well, right? So then that reputation is on both of us, not just with the client, but if we're representing the buyer, obviously we're talking about, but the seller's agent, right? They can do their due diligence as they should, which I'm going to talk about in just a second. But then the seller is upset. It really blows a lot of things up.
Yeah,
it's a big deal.
And a lot of buyers, their thought is, if I'm going to go get a loan, I'm going to go to my local bank. Some people will go online to some of these internet lending companies. A lot of people do start with their bank because if you think about it, it makes sense. Banks, that's what they do. They write loans. They help you borrow money to do certain things. And a lot of people make the sort of, wrong judgment that a bank knows you. You're a customer of the bank. You're going to get a better deal through them. It'll be an easier process. But when you're getting a mortgage loan, it's the same product no matter what company you're going to. So nothing's going to change. So a 30-year loan is the same regardless of the institution. It's just the process of getting that loan and the people you're dealing with. And I've made the analogy before, like if you're buying a car, if you want to go out and buy a brand new Mercedes, you go to 5 different Mercedes dealers, it's the same car. Mm-hmm. It's just different people, different service, different feel. Mm-hmm. And that's how it is in mortgage lending. It's all regulated. It's all the same. Do you want to work with a large, huge national company, or someone that might sit down with you and have a cup of coffee with you to go over disclosures and make sure things are being done the right way, explain what PMI is and all the different down payment combinations, as opposed to telling you something that makes you feel better. Mm-hmm. Like free, right. This is free, or you're our number one customer. All that stuff is nice to hear, but is it really worth anything?
Yeah. And then you don't hear from them again ever. And it's
or they're out of the industry,
or they're gone. Yeah. It's transactional. And here, listen, sometimes transactional, it's going to happen, right? And but it's definitely a different feel. All of the clients that I've worked with the both of us have just raved about, especially the first-time home buyers, and really actually the second and third time home buyers as well. But the first time home buyers, they just felt comfortable the entire way. And which is, that's what we're looking for.
Yeah.
But then the second time home buyers, which is just as important, right, is like most of the time they have to sell a house first before a contingent offer. We were talking about it earlier.
It's super stressful.
It's stressful. And just us being able to walk them through that. And it just makes a big difference. As opposed to just being tossed into a call center at some point, which we just experienced that a couple of months ago. It's really tough.
It is, and people don't know until they know. And I always like to talk to anyone really that I'm helping that, when they're going through this process, it really should be fun. You should enjoy buying a house. Everyone likes buying stuff. Buying real estate. There we go. Buy you a step stool. Buying real estate should be fun. It shouldn't be a ball of stress, but it ends up being a ball of stress. And you need people in your corner that are going to help guide you the right way. So you're looking at all the right information and you're looking at from the right angle. Not everyone is going to fit the box the same way. So you have to kind of open up certain doors. A lot of consumers don't look out for themselves. They want what they want. Yeah. Sometimes it helps to kind of set some guardrails, some boundaries for them, so they're not buying, getting into a $5,000 payment when they really wanted $3,500.
I mean, this goes probably counterintuitive to, I don't know, maybe the industry or whatever, but I mean, we've talked a couple of clients out of buying a home from the standpoint of this just probably might not be the right time. And this is why. I mean, you're going to make your own decision, right? Yeah. But just looking out for them, they would have been in a situation. And it's obviously incentive, everybody wants a deal to get done, right?
Right.
It's, that's in our world, but a lot of our business is referral-based business. And, I wouldn't be able to sleep at night if somebody was not in a position to really make it work.
Right. And I was one of those people. The house I live in now, I bought above my means, and this was in 2005. And anyone was getting approved for a loan. I was in the industry, so you think I would know better, but I used one of those crazy risky loans, which was the option arm or pay option arm, depending on what you want to call it. And I was young, and I thought nothing could ever get worse in our world, in our economy. Young, I was making good enough money. So I thought everything was going to keep going like this. Yeah. And then it went like this.
Quickly. So
I share that with a lot of people when I'm helping them to just think ahead of schedule a little bit. Think, hey, maybe I just got married, but what if I have kids unexpectedly? Then maybe I shouldn't do a 15-year loan, maybe do a 30-year loan, or take into consideration association fees or taxes go up. All this stuff gets more expensive.
A furnace going out.
So
you went through the downturn in 2008, and then we had, 2020, and then everybody experienced this crazy real estate boom after that, which is kind of, it's peaked, right? It's from the standpoint of just the craziness. It's balanced out. What, from your standpoint, and I'll give you my standpoint as well, but from the mortgage side, how is it different from the 2008, the 2008 bust? And does any of it, the fear that I have heard, and I'm sure, it's out there, right, is that the bubble is going to burst in the housing market. And it's really not. That's just not the case. Yeah. It's so different than 2008 when that happened. So, but from your standpoint, what are your feelings?
I mean, they're night and day differences because the bubble did burst, and you have to understand what caused the bubble. Mm-hmm. And remember, I said when I started in the industry, the market was awesome. All values were going up. Houses sold themselves. The other huge component to that was there was no guidelines for mortgage loans. You could buy houses with no money down.
Yeah.
You didn't have to have any verifications, which is a huge risk. So people could literally buy a house as long as you had a certain credit score, which would be 680, I think at the time was the top tier, which in today's world is considered kind of not so good.
To low, yeah. Mm-hmm.
And as long as you had money available, you have to have a credit score and just have the money. I don't even think we cared where the money came from. We wouldn't verify employment. On a loan application, it wouldn't even allow you to put in employer information if you fell into this category. So no income, no asset, or NINA is what they called it. So when that started shifting a little bit and people realized they couldn't afford their houses because some of these risky programs, their payments may have changed in 6 months or a year or 2 years after, and they would go from a $1,500 payment to $2,000 to $2,500. No big deal. You sell your house, right? When this started happening on a macro level and everyone was trying to sell their house, there was no one to buy the houses. And it just sort of had a snowball effect. So that was really more of like a traditional bubble bursting where everyone was affected by it. Now, yeah, values have gone up a ton. They're still going up a little bit now. But all of the loan programs are fully verified. They're fully documented. There's no more risky programs. That created a ton of government regulation for the better because everything's on an even playing field. Consumers, for the most part, cannot get themselves in any like uncomfortable financial position. It's all regulated. Everything's totally verified through underwriting. And it's just a much safer, stable market. So when they're talking about the bubble, there really isn't a bubble, especially in Illinois.
Yeah.
Other states maybe.
Yeah.
But Illinois and the Chicagoland area has such a relatively stable market. And there's tons of jobs in Illinois. There's no crazy weather that you have to worry about. Hurricanes, mudslides.
Which affect insurance premiums.
Huge insurance, yeah. Insurance premiums are outrageous around some of the coastal areas. So the natural disasters aren't happening. The job market is super stable. And it's a relatively stable housing market. So houses are not doubling in 2 or 3 years like they might be in parts of Florida. So therefore, there won't be a bubble because there's also, I don't know how many buyers are still looking for houses. Like there's a housing shortage.
Yeah.
And as long as there's a massive housing shortage, there won't be a bubble.
Right.
Like values aren't going to come plummeting down. And I mean, we were just in a meeting a week ago talking about the amount of buyers that are looking back, like they didn't buy and saying, man, I wish I would have bought last year.
Yeah. Mm-hmm.
I wish I would have bought last year. And it's staggering because they're losing on all the potential equity and value as opposed to paying $3,000 or $4,000 or $5,000 a month in rent.
2008 was a mortgage bubble, not a housing bubble. That's kind of how I separate the two of them.
Yeah.
It affected the housing values, but it was almost more of a mortgage issue as opposed to the homes appreciated because of the mortgages, really more than anything.
Yeah.
Right? Yeah. So I just feel like they're two separate things. And now there were just too many darn houses on the market back in 2008. I mean, at the end of the day, foreclosures,
right? Because no one could sell it.
Yeah, you couldn't sell them.
You would have a house. If you were selling your house, you would have 20 other neyors doing the same thing.
Yeah, I remember. Yeah,
and only one buyer.
Yeah, that could legitimately get approved to buy the house too. And so it's so much harder to get approved to even buy a house. You'd probably have a ton of people that wanted to buy a house, but they couldn't.
Right. And right now that's not happening.
Mm-hmm.
We're talking about inflation that is still an issue.
Yeah.
And the job market is still strong.
Mm-hmm. Yeah. And I think the thing that just gives some buyers hesitation is just, cost. I mean, and it's legitimate, but I think that, and then I think people got so used to seeing 2.5%, 3%, right?
Yeah.
Mortgage rates, which was awesome. If you're able to do that or refinance at some point, I mean, that's most likely a once in a lifetime thing, right? And then you all of a sudden see 6-7%. Sometimes, did we see anything above 7? I feel like we saw.
Yeah, we had some 8s.
Yeah, we touched 8 at some point.
We had some 8s for a little bit.
Yeah, I mean, and honestly, 5s and 6s 6.5, mid sixes is
Yeah.
probably going to be the norm. Or not probably. It's going to most likely going to be the norm, right?
I mean, it's been here for years now.
Yeah.
So,
and I think people are getting used to that and they understand it.
yeah,
and,
it's unrealistic to think you should expect a 3 or 4.
Yeah.
So historically, 5, 6, and 7 is very normal.
Yeah.
Very realistic.
Yeah.
I think 5s are actually probably below a little bit. So,
Yeah.
and you can never time it. That's another issue that comes up with a lot of consumers. They may want to wait until rates get to a certain level. It's almost impossible.
Yeah.
So,
to my point of when I started out the podcast, saying that some of the questions that I get asked on a daily basis is what are interest rates and what are they going to be in 6 months? I can tell you what the interest rates are right now.
yeah.
I can't tell you what they're going to be tomorrow. I can't tell you what they're going to be an hour from now. To be honest, like there's a point. We have an idea.
Yeah.
Just based on our experience, and but it's pretty hard to predict that stuff.
Yeah, there's too many variables on where rates are going to go, especially with the global markets, the global economy. Sometimes if there's global conflicts, that could be good or bad for mortgage rates, but you have no idea.
Yeah.
Sometimes people try to time it during election years, thinking that's all of a sudden going to work in their favor.
Yeah.
But again, if that was the case, and especially when it is surrounding buying a property, if there really was truth to that, everybody else would be doing the same thing, which is going to cause a lot more competition. And now you're going to end up overpaying for something in a different way instead of trying to time the market. So we always talk, if you want to buy something and it's the right time, just buy it. Don't wait for something out of your control. If you need to get gas in your car,
you go and get gas.
Get gas.
Yeah.
You don't wait for it to come down 10 cents.
Yeah.
In 2 months from now.
Yeah, and so to that point again, the refinancing side, right? Like we were talking about this just a while ago. I think it was back in September. There was a huge dip in rates for.
It was short. It may have been a couple weeks.
It was a couple weeks, okay.
But it went right back up.
Yeah.
So rates may have come down like 0.5% or 0.75% back in September of 2024.
Yeah.
And we would talk to people, go through the numbers, explain what the benefit might be. And so many people make the fatal mistake of saying, I'm going to wait until they keep going down and I'll get it at the bottom. The only way you can measure where the bottom's at is when they've gone back up, because then you can see where the bottom was. So we could probably spend an hour on refinancing.
Yeah.
But I always, I like using analogies. And mine is when you're talking about savings. If there's a savings there and it makes sense, take it. So my analogy is, if you were to walk outside to the mailbox, get the mail, and there was $150 laying in the street, would you pick that up or would you wait until another 50 blew and rolled on top?
Pick it up.
Pick it up. Take it. It's free money. Save it while you can. And it's a fixed reduction for the life of your loan. And if rates come down again, that's what people always say is, well, what if they keep coming down?
Refinance.
That's an awesome problem to have.
Yeah.
Could you imagine if I were to call you in a year from now saying, guess what? I know you just saved 200. You might be able to save another 100.
Yeah.
You're going to have a process and procedure, and there's cost involved. Still a good problem to have.
Yeah.
I wish I got that call every year.
Yeah.
So.
Yeah. And I want to preface that we're like, that's a genuine comment. Like I guess like my grandpa always used to say, never ask a barber if you need a haircut, right? Which is true. Yeah. But like Kevin's not saying that because it's not true. I mean, it's true. He's not saying it to get refinance business. It's true.
Yeah.
I mean, you only know the bottom when it goes back up. And
it's true.
And that's not just to get business. So, which I just think it's important to put that out there. So,
yeah, student loans have not had much of an impact. The only negative thing that's come up is during COVID, a lot of student loans were in forbearance.
Oh, that's right.
Deferred. So when we pull credit, there was no payment on there. The consumer didn't have to make payments, but they ended up going back into repayment mode. And a lot of times people didn't get a notice on that. Or if they did, it was an email that was buried in with a million other emails. It wasn't a dramatic, flashy letter in the mail or anything like that. And some people unknowingly were in default and they didn't realize it already kicked back in. I personally have not seen that, but I know a lot of my colleagues have had situations where someone has perfect credit, and then all of a sudden they want to get pre-approved, and now their credit's at 580.
Gotcha.
Because they have 6 months of back payments on their student loans.
Gotcha.
But that's rare. So other than that, I mean, what consumers don't realize is when we pull credit and we see student loans that have zero payment, so they're in forbearance or deferred, we still count a payment against those. There's a calculation we have to do, which is relatively low. It usually doesn't become an issue because, we either do 0.5% or 1% of the loan amount.
Okay.
The only time I really see it being an issue is if you have like a lot of student loans,
Yeah, for
like
sure.
$180,000 or $200,000 worth, and that would be $1,000 to $2,000 a month for a payment. Usually it's a few $100s, and we can usually work around it. It's not something that we have too much trouble with. And a lot of people don't realize you can always pay off debt to qualify. So if you want to buy a house, but the house you want to buy, you're just over the guideline a little bit, and you have a car loan that maybe you can pay off, maybe it doesn't have a ton of money left, we can condition for that loan to be paid off, and boom, you qualify. So we do that all the time. It's really helpful.
Yeah, that is helpful. You just have to pay it off then at that point. That's
or we would pay it off at the time of the closing. So you just have to have the money available. You can borrow money from a family member. You can get, there's a lot of ways to make something like that work. Yeah, it's kind of like similar to one of the headlines that came up not too long ago about a 50-year mortgage.
Oh, yeah.
Which we got a ton of calls about.
I believe it.
This.
I did too.
It was nothing more than a thought that this could happen. But if you run the numbers, I think I did it on a $400,000 loan. When you shift the payment term from 30 to 50, you think that payment would be like half of what it would be. It was like maybe $250 a month less.
And how much more interest are they paying? It's almost double.
Basically renting.
Yeah.
All your money is going towards interest. But, $250, obviously, it's $250. But when you're talking about trying to buy in today's market, depending on where you're at, $500,000 house, you won't even notice that difference in your payment.
Yeah.
So the difference between having a $4,000 payment or a $4,200 payment is not night and day.
No.
You're not going to just be traveling 3 times a year because of the 50-year mortgage.
Right. And that's really going to hurt you in the long run from a finance standpoint because you're just doling out more money over a longer period of time. And you don't want to do that.
You'll never pay down the loan.
Never.
It's almost the same as renting. I mean, it really is. So yeah, if you figured out the amount of interest you would pay over 50 years, if you kept the loan and stayed in the house for 50 years, it would be, I think it was like $1 million in interest.
Yeah, I remember we've done the calculation a million times on the laptop, and it just none of it made sense. So, I mean, I think one of the I had one person call and say, "Well, what if I just sold it in 2 or 3 years anyway?" I'm like, "Wouldn't that make sense?" I'm like, "Okay, yeah, sure, but like, are you gonna?" I don't rent. Yeah, just rent something for a couple of years, and like, it's going to be hard to get. If you're moving every 2 or 3 years in this market, you might get your money back.
There's cost involved when you're moving.
Yeah. And not just cost from a mortgage or real estate side. I mean, it's, moving costs.
Yeah. Like inspection costs. You have to fix certain things. When you're renting, you move in, you move out.
Move out if you're only going to be there for a couple of years. Yeah. So that's an example of talk somebody out of buying a house. That just didn't make sense for them.
Waiting a year or two to plan is not a bad idea, which is what a lot of people are doing. Hence the 40-year-old first-time home buyer.
Yep.
I have seen more people buying houses with hundreds of thousands of dollars saved up.
Yep.
Because they're waiting.
It's refreshing to see. Yeah. Honestly. Yeah.
So it was always frustrating when people would call me and say they want to buy a house, and I would always ask them, "Do you have any savings yet? Have you started saving?" And they'll say, "No, I haven't, but I have about $2,000 in the bank."
That's going to be a little tough.
$2,000 is not going to get you far to buy a house.
Yeah. That's not.
Those are individuals that you would comfortably want to say, you might as well wait. Well, I think one of my highlights, it really has nothing to do with the client directly, but showing up to a closing with a clip-on tie.
Clip-on tie.
It's such a classy move, and I still have it. if you ever want to impress someone, I would invest in a clip-on tie, but then take it off like mid-conversation and
Just like this.
clip it back on.
See if anyone notices. Did Blake get one?
He may have gotten a wooden tie or something. I think all three of us did.
Yeah.
But I remember I wore it to a lunch in downtown Naperville, and I was going to show it off as a joke. This is right in the middle of the day in the summer. So it was warm out, and I was walking. It was windy, and my tie kept blowing over my shoulder. And I kept thinking, oh, my goodness, what are onlookers going to think if my tie blows right off?
Oh, that's going on social media immediately.
Like I'd have to grab the tie and run so no one could take a picture of me. So that was a near humiliating experience. Luckily, I think I was just holding it at that point, so it didn't fall off.
You were just taking it off.
Yeah, well, yeah, but then people see me. Yeah. That's probably my most fun moment. But if I had, I'd have to think. Usually it's not like exciting, fun moments.
Yeah.
Some of my friends in the industry are just kind of magnets for stuff like this, but probably not appropriate to share. I'd probably be my last time on this channel. We'll just keep with the clip-on tie.
Let's stick with the clip-on tie. Oh, all right. On that note.
So I think it'll be a little bit more of a normal market just because the amount of time that has gone by since COVID and the amount of attention I've seen in the very, very beginning of January.
Yeah, I agree with you. I think it's going to be a stable market, or it's trending in that direction as well. I think we're already seeing that. And I think there'll be a pretty significant amount of homes that come to the market. I don't think it's going to be overwhelming, which is okay.
Yeah.
I don't. I do think, I read a statistic yesterday. I'm not going to get it exact, but there are now more outstanding mortgages out there that have a 6% mortgage rate than there are that have a 3% mortgage rate, which has not been the case in the past.
Yeah.
Everybody had a 3% mortgage rate.
Why is that? Because people eventually paid it off or sold it?
A lot of people paid it off or they sold it. And a lot of them paid it off. Which is interesting. That was surprising to hear from the paying off standpoint, but you just get rid of an expense. I mean,
Yeah.
But the whole thing is shifted into being more balanced, and which is why I feel like, and just to our point earlier, the whole mortgage interest rate thing, we're just getting used to the norm of what is probably would have been normal anyway if the COVID thing didn't happen.
Yeah.
Of the 6-ish. Between 5 and 6-ish% mortgage rate. So,
that too. So the whole interest rate thing. So now that rates are no longer near 8 or locked into the 7s, that they've drifted down. This is another thing about predictions. People predicting rates are going to come down. They've already come down. They're down about a full percent in the last year. So there's already a huge shift in the market. There's also thoughts that rates might continue going down. So the more the public hears this, it's positive momentum with everything else that's going on. So I think that's going to trigger a lot of people to look at their mortgage statement and say, you know what? I know we didn't want to leave this 2.75, but we can only wait so long. And it just is what it is now. I'm okay with leaving that behind and, breaking up with my 2s and 3s.
Yeah, for sure. I mean,
to live where you want, because otherwise you're going to be living in a house that you don't want to be in, which is not fun. Yeah.
And some of those first-time home buyers that bought in, 2019 between 2019 and 2021, maybe even 2022, maybe they settled on a house.
Yeah,
at that point,
that's true.
There was a lot going on, and maybe got ended up with a smaller home than they really wanted at that particular time, but have waited out on the interest rates because they have gone up so much. However, the value that they have in the home has gone up.
Yeah, they have a ton of equity.
Yeah, their equity is great. I've been sending them. So every year, this time of the year, I send past clients a home equity report.
Oh, it's a good idea.
Kind of like almost like a financial advisor would send to their so just a checkup, and there's no pressure for them to sell. They know that. It's just so they know their numbers. It's really important for them to know their numbers. And some of them call back just to have me walk them through that. I'm always happy to do that. I really enjoy that stuff. But there's some folks that have a lot of equity, and it's it really kind of it changes their feeling of what they want to do. And now, as we were talking about earlier, it's more fair, more of a fair market for them to be able to buy something, and they'll still get top dollar for selling their house too, right? So it just makes sense.
Yeah, and for those reasons, I think this is going to be a better year than we've had for the last 3 years. More consistent year instead of just a busy March, April, and May, and then have everything just stop until the following year. So, and who knows if rates will come down? But like I said, they're already down. We're already there.
Right? Yeah, you're there.
So we are comfortably in the sixes now. That might be a question people are probably thinking is, well, where are rates? We're talking about rates. At least as of this moment in time, everyone is in the sixes. Some people might be in the fives. So
depending on
everyone was in the sevens.
Yeah.
So depending on down payment, credit, where the property is located, there's a lot of other factors, but I haven't had any rate profiles probably above 6.5 in the last couple of maybe month and a half, 2 months. Everyone's been at 6.5 or below. Some people are starting to drift into the fives.
Okay.
And that's a market rate. That's not with points.
Yeah. So that's a good question. We didn't talk about points, right? No. Yeah. So be careful the headlines that you read and what you click on when it pertains to mortgage rates. Because I did this yesterday just to see what was out there. I do this normally every day, and then usually I shoot Kevin a text to see if it's true or not. And almost all the time it's not true. But there's quotes out there for rates that I saw at like 5.65. I think I saw one for 5.385, and they just want you to click and call them. But it involves points, which is a legitimate expense for people when they are considering a mortgage. So do you want to talk a little bit about points?
Yeah. So dealing with points gets somewhat frustrating because every consumer is on their phone when they're trying to get an idea where the market's at, whether they just Google where are mortgage rates or they go to like bankrate.com or any of those websites. And everything you see, typically you're being pulled into a website, right? If I'm Googling mortgage rates, you might get 10 bank websites that would pull up. And you click on that one website, but you don't realize in the back of your mind that you're actually looking at a big marketing engine when you're looking at any company website. So they will always promote the best of the best that they possibly can without flat out lying. So you might see something like 5.5% for a 30-year fixed, but there's a paragraph of small print below that or at the very bottom of the website, and it'll have all the assumptions built in. This is based on a 780 credit score, single family home, a loan amount of $350,000 or more, maybe in a certain state. Might be the state of Texas.
I saw a state there yesterday for sure.
There are geographical differences when it comes to interest rates. So some states have certain margins that are, for whatever reason, added in. There's an explanation to it, but I don't remember what it was. And a lot of times it'll say this assumes 1 point or 1.125 points. And that is something you don't have to pay. But they add that in there because it looks better to promote it that way.
Yeah, it makes the rate look better.
When you hear about, and you'll hear this on the radio, you'll see it on TV or on your phone, that Fannie Mae or Freddie Mac, it shows their national average. That's still, you can't go off of that because that may not be you, right? Yep. So if you have not so good credit or you're only doing 5% down, you're not going to fall into that national average. So you can't really look at that. Maybe if you're looking over the course of time, you can see that national averages come down. But those averages usually have points built into that too. Mm-hmm. So points it's a mechanism for a consumer to basically purchase a lower rate. You can, if the rate today is at 6.5, you can say, hey, can I buy 6%? If so, what would that cost? And there's a grid we look at called the point system. And 1 point cost 1% of the loan amount, which is expensive. Mm-hmm. It's a $500,000 loan. 1 point is $5,000. Rule of thumb is 1 point knocks off about 0.25% on the interest rate. So if you're going to save $100 a month, does it make sense to spend $5,000 up front as a one-time sunk cost to save $100 a month?
Right. Then you're out $5,000 right away. And then
add it on top of your closing costs.
Yeah. When you can probably just refinance later anyway, maybe. So
we talk about points all the time
because
we have to, because every website people are looking at have points built in. They don't know it.
Right.
So we have to be aware of this. And points, it's easy to determine if it's worth it or not. The numbers will speak for themselves, or the math will tell you whether or not it's worth it if you have the money. Mm-hmm. But it's a calculation. It's a risk calculation because, you might save money. There's going to be a break-even point, but how long do you plan on keeping the loan? Are you going to pay it off? Are you going to move? Are you going to refinance? Then we have to think about that. So most people usually don't pay points, partially because of what we talked about in 2008.
Oh, yeah.
There were no rules or regulations on the lending side, and lenders would charge points to just take money from the consumer for revenue.
Yeah.
That doesn't happen anymore. Yeah. So points are points nowadays. So it just... people don't understand them, so naturally they stay away from them.
Yeah.
So,
but it's clickbait.
It is, and this is where we were talking about the lending organization that you have to be careful because a lot of your internet lending companies will have points built in, and they will promote their really low interest rates. They won't talk about points. And when you get your disclosures through email, you open them up, and holy cow, what is this $15,000 I'm seeing? And then that all unravels right there.
So I had a client who was using a lender that it was one of their like a friend of a friend or something like that. I don't remember. And they wanted to, give him a shot. The disclosures were sent to me as well.
Really?
I saw them, yeah, and I saw it.
They copied you on the disclosures?
Yeah, they didn't mean to, but they did.
So that's a huge.
It's a mistake.
They're not supposed to do that.
Yeah, but I saw them, and then I saw that they were paying points, and you don't see people paying points very often.
No.
And I know they were trying to save cash, so it didn't make any sense.
Yeah, right.
Like it didn't make sense to me. So I called them and let them know, hey, are you guys paying points? And they said, what are you talking about? And, unfortunately it was a tough conversation that they had to have at that point. But we were getting ready to close. So they fixed it and it was fine, but they can be buried. So you just have to.
There's so much information that's happening from start to finish.
Yeah.
It's easy for a consumer not to catch it because they don't know what it is. They don't know what they're looking for. There's so many numbers. Some are estimates. Some are intentionally overestimated. Some are not on there yet, like tax proration. So it's easy for that to just get pushed along.
Yep.
That's the biggest thing is just not necessarily lying or being deceptive, just not really filling you in. Not educating a consumer.
Yeah,
that's
yeah.
People really need someone to help them.
Mm-hmm.
And when you go online, is just trying to answer a call in a queue and speed you along, and it's all numbers.
Move you to the next person in line. And
I used to work. That's when I started in a call center, and we would have a phone queue that was flashing, and people would be bonused on how long the wait time was.
Oh, wow. Yeah.
Not me, but like our managers.
Yeah.
And you had to answer the call and then try to get to the next call. So there was very little time really helping someone because you didn't want people burning in that queue.
Right.
So you had to hurry up and empty the queue so there's no hold time.
There's no incentive for the manager to teach you to educate your client.
Right.
You're like literally just pushing them aside
Right.
or moving them along.
That's why it's a big difference when you go to someone in my world that would spend 5 hours talking to someone if need be to go through all the details.
Yeah.
There's no queue.
Yeah, which is really, really nice. And they can get a hold of you. How many times have we talked to people like Saturday night or whatever, Sunday morning, Sunday night? I mean, it's not we had a loan with a particular company where they work 9 to 5. They do not have a phone. They don't provide you their cell phone.
Yeah.
If things come up over the weekend, it's just the nature of our job.
Yeah.
But we would have to wait until Monday. And you know how corporate works. It's just at some point we'll hear from them on Monday. And
it doesn't work too well.
It doesn't work. Yeah, not in our world.
Not in today's market where timing is everything.
Yeah,
multiple
exactly.
offers.
Yeah. So you hungry? I didn't order pizza.
I think that's just from the pot of coffee
I've
had today.
You can go. Don't feel like you have to wait. All right, everybody. Thanks for joining us on our very first episode of Cup of Joe. Excited to share this with you. Kevin, thank you so much for coming by. I really appreciate you taking time out of your busy day for this.
Thank you. I'm honored.
Yeah.
Proud to be your number one guest.
You're number one.
I hope I come back.
Yeah. Well, we'll see how the Bears play this weekend. All right. Have a good day.